Take a look at the charts. Gold is skyrocketing and is definitely not moving like a normal, healthy market. It looks more like someone chugged an energy drink at 3 a.m. and decided to completely overhaul their life. Historically, gold has been a boring, slow and steady asset, averaging about a 6.5% annual return over the last 40 years. But over the past 5 years, that number has surged to nearly 20% annually. Clearly something unusual is going down. Either the global economy is breaking, or we're seriously underestimating humanity's emotional attachment to shiny yellow bricks. And while analysts and armchair experts argue over the why, let's break down the actual facts. Spoiler alert, it's not just inflation. The first culprit everyone points to is inflation. Sure, the cost of rent, groceries, and fast food has spiked so hard, you'd think your standard drive-through burger is now made of Wagyu beef. But here's the catch. If gold was just a simple hedge against inflation, it would have exploded back in 2021 when prices first started going crazy. It didn't. It barely budged. This massive momentum is recent, meaning there is something much bigger and scarier brewing under the surface. For the central bank's quiet rebellion, the real story is that foreign nations are quietly losing faith in the US dollar. And by quietly, I mean the exact same way someone silently deletes all the couple photos from their Instagram feed a few weeks before making a breakup official. The signs were always there. People just chose to ignore them. The US dollar has been the undisputed king of global finance for 80 years. But look at the shift. 2 decades ago, global central banks held over 70% of their foreign exchange reserves in US dollars. Today, that share has dropped to 58%. A 12-point drop might sound like a rounding error, but at the sovereign level, we're talking about trillions of dollars moving. Central banks are loudly dumping the dollar. That would trigger global market panic. Instead, they are quietly diversifying. They are tiptoeing out of the room, trying their best not to wake the dragon. Gold is the ultimate plan B. So, where are those trillions going? Not into the euro, the British pound, or the Japanese yen. They are flowing straight into gold. The metal has become the ultimate financial prenup, just in case the global economy goes south. Central banks are hoarding gold at a record-shattering pace. For 3 years running, they've been buying over 1,000 tons annually. This is more than double their historical average of 400 to 500 tons from previous decades. Over 40% of these banks plan to keep increasing their reserves over the next 10 years. This isn't a passing trend. This is a deep-rooted institutional anxiety. The biggest financial players are hedging against the massive U.S. national debt and the risks of being overly reliant on the American financial system. The ultimate paradox: mixed market signals. The most confusing part of all this is how other assets are behaving. Right now, the stock market is hitting all-time highs. Investors are throwing money at AI tech stocks like we're already living in a post-scarcity utopia. Normally, markets are logical and pick a lane. Or risk on, investors feel optimistic, buy stocks, and gold gets ignored. Risk off. Investors get scared, sell stocks, and run to the safety of gold. But right now, both risk assets, stocks, and safe haven assets, gold, are breaking records at the exact same time. It's massive cognitive dissonance. The market is acting like a girl who says, "I'm not looking for anything serious right now," but then immediately asks what you want to name your future kids. The bottom line: the smart money is quietly building a massive safety net before an actual crisis hits. This isn't panic buying. It's preemptive positioning, and it reveals exactly how the people running global finance are actually feeling about the future. What are your thoughts on all of this? Drop a comment below. I'm really interested to see what you think.